And good Monday morning to you. My name is Jeremy Torgerson. I am the CEO and nVest Advisors, LLC rather. We're a Texas-based registered investment advisory firm located in very, very sunny, hot, scorching hot, and very humid Brownsville, Texas. Our website is www.nvestadvisors.com. Just take the I off the word invest and run it all together, nvestadvisors.com. You can also track and follow us on social media of every variety. We put these podcasts on iTunes. There's also a video version of them on YouTube. I think I've seen even some websites that are podcast friendly are grabbing this without me even knowing it. So if you see Money in 30 podcast around, that's us. You can also watch and follow the firm on Twitter, Facebook, Google+, oh my goodness, LinkedIn, anywhere you can probably go for financial or social interaction, we're there. We can also see some of our publications now on LinkedIn Pulse. You have to look for me specifically for that, which is Jeremy Torgerson. You can look there. I want to give a special shout out this morning. It's Monday, again, August 22nd. We have many, many school teacher clients, and not just school teachers, but school district, I should say, employees who are clients of nVest Advisors. And my children were both recent graduates of the Los Fresnos Consolidated Independent School District here in Brownsville, the Brownsville area. Fantastic school district, fantastic people. My kids got a fantastic, awesome education, and many great clients and friends that are part of that district. So I'm glad you're all back to work doing very, very important work for our kids. Thank you, school teachers, no matter where you are in the country. You guys do a great job for us. I want to give us a talk this morning about why you might consider, if you're working with a financial advisor already, or if you're shopping for one, why you might want to change course or consider not doing business anymore or at all with a financial advisor. So this actually came to me not because we have any particular axe to grind with financial advisors, but we get in this industry, and I'm sure many others, if you have a field of expertise, reporters for major publications love to get professional people to give quotes for their articles. And so I got one, I think about a week ago, from a reporter, and I'm not sure when they'll publish that, but they said, can you give us some information on why a person should not work with or fire a financial advisor? So I thought about that and wrote her a very long email back with my answers, and then realized, well, that's about a blog post length anyway. I may as well just go ahead and put that on our firm's website. So I did put that up. You can go to the website, look at the bottom of any page, you'll see recent blog posts, and you can have the full text of what I'm talking about today. 9 reasons to fire your financial advisor. When I started my practice, and I was with a major firm when I first began, as most people have to be. You have to be trained somewhere, and I was trained with a major regional wirehouse in the United States. It's a very large firm. I started in August of 2008. So it was right before the collapse of Lehman Brothers and then that subsequent plummet of the stock market that bottomed out in March of 2009, about 53% down, I think, on the Dow from its highs. So it was a devastating time to start being in business. But it was an interesting time in the sense that I picked up a lot of clients in that time because of the inactivity mostly of their current financial advisors. So they go through a period of time when people are very much just as a collective looking to change financial advice. It's always during down markets when you get mad at us as your financial advisors, although we have very little to do with controlling it, and nobody has a crystal ball to see when the markets are going to go down. And anybody that says they do, they might be right every so often, like every very so often, but I would be very cautious about a financial advisor that says somehow they've either got a system or they've got special knowledge or insight that can predict the future. But people actually will do that in this industry, among others, to put themselves out as some sort of an expert and differentiate themselves that way. But anyway, I picked up a lot of clients in that time. And then ever since, when we've brought on a new client, and we have clients all over the country, it's not just here in South Texas, but I'll always ask them, how did I earn your business? Or how did your previous advisor lose your business? And many times it was, they stopped being responsive, or we just weren't happy with returns. But nobody can really give me sometimes a very specific reason why they fired a financial advisor. So this morning, I just wanted to talk to you about, as I answered these questions for reporters, I thought, this is important. How do you know if you're working with the right person or not? Or from an inside person looking out, and I don't know even who listens to all of these podcasts, so it's not like I'm talking specifically to you. And I'm not trying to make a pitch for you to become a client of ours, although if you like what we do and philosophically we fit, then great. Talk to us about it. And we're not going to push you to do it and try to bully you into becoming a client. This relationship between you and me, a professional relationship, is built on trust. It's built on the fact that you're going to share a lot of really deeply personal information with your financial advisor. And you're laying your blood, sweat, and tear money and your hopes and dreams for your future in the hands of this person. And so it's very important that you've picked the right person, or it's okay if you realize a few years down the road that maybe this wasn't the best fit and maybe I should look elsewhere. So I want to give you this morning, and I'll quit giving it preface and just get into it, 9 reasons that I believe that you could consider working with a different financial advisor. Now, let me start by saying the first thing, the caveat is this. You will not hear in these 9 items that my account is down is a reason for you to fire your advisor, okay? We'll all have times, if you are invested in anything, that your account value may be down. Okay, there are certain times, and there's nothing wrong with the investment, and there's nothing wrong necessarily with the financial advisor's advice or service. There are just times when the entire swimming pool drains of water at the same time. And if you think about your investments like beach balls floating on the swimming pool, even the most sturdy, solid, well-built beach ball, there are times the beach ball will drop if the water level in the pool drops as well. So it's very, very important that you understand that the financial advisor is not a prophet. It is not, he or she is not a fortune teller. And really, if you are a financial advisor who listens to this and you make pledges to your clients of X dollars of return or X percent of return over the market, and if you're really bragging about the return you can provide for your clients, or that your particular strategy is going to wow and amaze and never have a down thing, shame on you, and you're going to be swallowing your own words very quickly. So anyway, that's not a reason necessarily to fire a financial advisor. Unfortunately, that's probably the most common reason that people move from a financial advisor, is they get impatient for a particular strategy to work. And that's just something I want you to keep in mind. Just because the account is down is not necessarily a reason to go. Now, if the account is just consistently down for years over the other market, yeah, you need to look at that. That's a different thing. But if the market drops 25% as a whole, as a broad market drop of 25%, and your account fell 15%, you may not like that, but there's something in the advisor's strategy that saved you from that other 10% fall. That's not a bad thing, okay? Just keep that in mind. But here's the things that I think should eliminate a financial advisor from your consideration, or honestly, that if you're already with them, you should probably move on. Here's number 1. If they act like less of a planner and more like a pitch maker. Okay, and I know that everyone knows this dude, okay, this guy or gal who's in this business. They've got a big smile, they're wearing a beautiful suit, they've got their new account application is still warm from the printer. You know these people, that they engaged you for the appointment knowing that they were going to get they're taking your business, okay? That feeling that you get from someone you're sitting with, that they're just sort of pushing hard to get you to sign up, is a big red flag. Okay, this relationship is very unique because it's not buying a refrigerator. You can't buy you can't open the doors and pull the drawers out, shut it, take it home, and you're done. Okay, this is about a person saying, "Let me hear from you what's important to you. Let me hear what your dreams are. What keeps you awake at night about money? What do you want your money to do? I mean, do you want to help your children, your grandchildren? It's all so very, very personalized that anybody that comes at you with an idea already in mind before they get a chance to know you, or they've got this product that, by God, they just know is going to be the right thing for you, is a financial advisor to avoid. Let me give you a true story about this. When I was brand new, right out of training, financial advisor, I had set up an appointment, my very, very first appointment, with a prospective client. And I was so excited. And she was a woman who her husband had passed away, left her some money. She had not managed it well, and she was down to not very much left. I can't remember the exact amount now, but it was like less than $100,000, and she really needed to stop spending it, try to turn around and grow some money back. But I got to her house for her appointment before I even had an office, and I was just so eager, and I sat down, and I was so full of great information about how to allocate your investments into mutual funds, and she was mostly like, the reason that she really had gone through it so fast was that she was a very unsophisticated investor and was mostly just a bank customer. She had her entire lump sum from the death benefit of her husband's life insurance in a savings account, and she was spending it with getting 0% interest on it and paying any tax on whatever pittance of interest that the bank gave her. And I was so excited to come in and talk to her about, we can do a mutual fund, thing. And I just I know we can do this and it'll be great. And I was earnest and I was sincere that I really wanted, to help her. She needed to try to grow her money, and I knew exactly the right thing to do. And this is going to be great. My goodness, what a good time, because the markets are down, and I just really came on too strong. And I never got her business. She was very reluctant. She was, put off by it. And I think that she had every right to be. When a salesperson, a good salesperson, finds out what you need and what you want and then gives that to you as a solution, okay? Or if they have the right solution, they can do that. But when I already had the idea. See, my problem was I went at it already with with a solution in mind before she even understood that she had a problem. And so I barreled over her with just kind of like vomiting out too much information about how these funds work, and let me draw stick figures with my little famous stick figure drawings I do in appointments. And it just was so overwhelming, it paralyzed her, and she never became a client. Her son eventually did for his own needs, but she was always very standoffish about giving us an account. And I totally understand why. Guys, think about it in terms of dating. If you go on let's say a blind date with somebody, and they are so eager and needy across the table from you, why? It's going to be off-putting. It's going to be, I don't want that. Why are they coming at me like this? And you would be naturally leery, naturally, turned off and suspicious. And you should be from a salesperson doing that, because that salesperson is coming at you because they need you, not because they have something that you need. You have something they need. They need a sale, or they need an account. So that's my number one, is if you have an advisor that just comes across from minute one as Mr. Slick, hi, how are you, kind of thing, and they've got the solution already, and that you just feel like they're trying to kind of push you to, we are the experts, we're the experts maybe on how to manage money, but you're the expert on you. And you need to know, the advisor needs to shut up long enough to listen to you and hear, what does this money need to do for you, for your family? And then what's the goal for it? How much time do we have to ride ups and downs? And then what kinds of investing have you already done? What do you feel comfortable with? What do you feel like when you open that statement? What are you going to understand right away? So if they don't take the time to really probe your comfort level with certain investments and understand what the money is supposed to be doing for you, I'd run, okay? Number two, if after you become a client, you never hear from them, okay? Now, this is something that I can say is none of us will be perfect at, because in this business, we have things that come up. You have new business coming in, you have clients to service, you have a lot of things, especially if you're a small shop, that you have marketing to take care of and compliance needs. And there's a lot of things in the business that happen behind the scenes. And your advisor may very well be working on your account behind the scenes. And, I'm even guilty of trying to make sure, like in my personal commitment, I want every client to be contacted proactively by me, at least every quarter of the year. So every 90 days, we're trying to get that done. And sometimes it happens and I'm so proud of myself. And then sometimes I can't connect with a client. They're out of town or something, or I just get backed up, where I tell myself I'm going to get to 20 clients today before I go home. And you're all the way to 8 p.m. And because of other things that have happened in the office, you got to 11. And then you've got to knock down some more the next day. So I'm not faulting an advisor, and you shouldn't either, if they're not perfect at this. I'm not talking about an advisor who, just they're working, but communication is something that isn't happening with as much regularity. In that case, just tell your advisor, I'd like to hear more from you. And the advisor's like, awesome. We have to walk a fine line in this business of communicating with you, but not over communicating with you to where you're like, what does that guy need when you see the caller ID again? So we have to kind of walk a delicate balancing act. For me and my clients, once a quarter is about the most of you want to hear from me. A lot of you don't want to hear from me unless there's a problem. And so we know that. So we send out, email communications and more mass communication things to keep you up to date on what's going on. And then when I need to get in touch with you, I do. But I'm talking about there's a difference between a busy advisor and a lazy one. And a lazy one is one, in my experience, that never keeps in touch with you. Here's another thing. If you haven't heard from your financial advisor personally in like more than a year, fire that advisor, okay? Because we are required by our industry regulations to have at least annual reviews with you to see what's changed in your life and look at the account and assess the strategy and make sure that it's all still suitable for you. Or in the case of a fee-based advisor who's responsible like a fiduciary, then you have that extra burden of making sure that everything I'm doing for you is always in the client's best interest, not just suitable for you, okay? So if you have an advisor who you haven't heard from in 18 months, fire the guy, okay? That's something that you absolutely should do. It's very, very different than having a busy financial advisor in a busy office who will get to you and is attentive when they do get to you. You know if somebody's busy or if somebody's lazy. You know it, okay? Number 3, if they work on commission. Now, this will probably make some of the industry people that listens to this angry with me. And I'll tell you, I'm not going to get into too much detail of, we can battle this one out later on. But there are 2 basic ways that a financial advisor can be compensated, okay? Both of them, by the way, you're paying for, even if commissions are a little harder to figure out how the advisor got paid for helping you. All advisors get paid from money that ultimately came from you, okay? So there's 2 ways we can do it. And some advisors actually do both ways. They call those people dually registered or hybrid advisors. But you can either take a commission for selling the client a product so the client buys the product from a vendor or an insurance company or some sort of, mutual fund house. And then that mutual fund assesses some sort of sales charge from you, the client, and then remits part of that to the advisor. Okay? So that's one way. So it's basically the same thing. If you buy a car, you go down to the car lot, you pay the car dealership for that car, and the car dealership cuts a little bit to the salesperson. Okay? Or a real estate transaction, basically the same thing. The other way that an advisor can be compensated is by a fee directly from you to the advisor. So there's no roundabout through a product. It's just a flat fee, either a flat fee. The advisor could say, I'll manage your account for $500 a year. Or the advisor might say, in our case at nVest Advisors, we say, we manage your money for a percentage of the assets in the account. We call that assets under management. So if your account is $100,000 and we charge 0.75%, then that's our take, okay? And that comes directly from the account, directly to nVest Advisors or your financial advisor. It doesn't get routed through a product. Now, I say all of that just to give you a quick explanation why I don't think in this day and age you should work with commissioned advisors long term. Number 1, an ethical advisor, okay? First, let me talk commissions. Let me go back up for a second. Commissions, if I'm paid on commission, that means I am paid to move your money into a product. Okay, I'm not paid for the performance of the product. I'm not paid for the success of the strategy. I am paid at the time that it moved in. So I'm paid for the transaction, not the result. I hope that makes sense. Okay, so when you have a guy who is earning a commission, okay, then that product may be great. And I'm not saying that commissioned advisors are unethical. I'm just saying that when you are commission oriented and you are commission paid, when you feed your family on commissions, a couple things happen in an advisor's mind. One, they are always chasing a commission instead of servicing the clients that they already have because they've already been paid on those clients. Okay. Number two is they do what we call in the business whale hunting, where they just want that big account. So the clients that generate the most revenue for them, whether they're people that are continually buying and selling stocks or bonds or things, or clients with the great big accounts, will always get more service and attention than the client with the smaller account, or the client like with the real stagnant account who owns several stocks for 10 or 15 years and they're just holding on to them, or they own a bond portfolio and they're just getting interest and there's really not much to do. The advisor makes no revenue from your account going forward, so there's very little incentive to go back and service it. They have to keep constantly lifting up the rock looking for that next client. Now, contrast that with a fee-based advisor. And this is what and there are some things you got to watch for fee-based guys, like they take a fee and actually don't do anything. That's a problem. But on the fee-based side, instead of me being paid to move your money in and out of things over time to make my pay, I am paid now to grow the account. Okay. For example, if we had that same $100,000 account and an advisor charges, let's say 1% fee on that account, the total advisory fee for that year, 1% of $100,000 would be $1,000 over that year that the advisor would be paid to manage that money for you. Okay. Now, as the account is invested and growing, hopefully, let's say that the advisor gets an 8% return on that account over that year, and now you're at $108,000 at the end of the first year. And the advisor's fee comes out again. Because the advisor did a good job and grew your account, that 1% of that larger account is more money to the advisor. So instead of $1,000 like you made last year, that advisor made you $8,000, but is now able to, their fee this year, because the account grew, is $1,080, okay, instead of the $1,000. So an advisor who's paid by a fee is money motivated to grow your account, not move it in and out of things, okay? So that was, in fact, something that when I was a duly registered advisor for a long time, that I always had an ethical quandary about. If you're an ethical commissioned advisor, you know that you're not going to want to touch the client's account very often, because every time I touch it and move something, it's going to cost you money. So I started to feel that I was kind of painted into a corner in a way where there are things that we wanted to do for you that we could maybe make some changes that would benefit the account, but I always had to weigh that against the cost of making the change. And if it just wasn't cost effective, then we just didn't do it. Okay. And so I felt like there were times that I could have given even more aggressive, more hands-on service to your account, but I was hindered by the fact that I did not want to charge you additional commissions. Now that may sound nuts, because what commission salesperson doesn't want to generate commission? But that's what an ethical one will do. Is an ethical advisor who's on commission will not touch your account very often, and probably put you in as few products as possible so that there's less under the hood to have to fix and tweak. Okay, so that's one of the reasons that I would say that in this day and age, it used to be a little bit difficult to get smaller accounts put with a fee-based advisor, and in many cases it still is. Many of them have account minimums. By the way, shameless plug, we do not at nVest Advisors. You can be an account with no balance. You can start with zero and at a fee of less than 1% for some of our programs. So please let me know by email or shoot us a line if you want some more information about that. There is no reason anymore with the technology that exists for you to pay extraordinary commissions on products. There's just no reason for it. So, all right. So that's the third one. Number 4, If, despite good intentions, they always seem to fail to do what they say they will do. Now, that's probably business 101. If you're going to be in business and you're going to hold yourself out as a professional, act professionally. Do what you say you're going to do. But if you have an advisor that makes promises and breaks promises, yeah, I'll be there. I've actually had a couple clients came to me because they had appointments scheduled with the advisor, and then the advisor didn't show up. No phone call, nothing. I mean, that just, to me, was like, how could you take a client that you have and disrespect them so much that they showed up for the appointment that was scheduled and the advisor had taken the day off and didn't know and didn't call? And I mean, that's something where if you have an issue like that. So same thing. If you have an advisor that's just not on top of their game and promises are falling through, service standards are dropping, obviously, those are things you want to get rid of. And that could be a very, very well-intentioned advisor. I'm not saying that people are always, devious or, we're not talking scumbags here. We're talking about a person who just maybe is overwhelmed. Maybe they have more, that's what I'm talking about with the higher end clients get all the attention because they generate the commissions. So if you're an average account and you're not a significant pain in their backside, many times you're kind of brushed to the back. And that's something that should not be happening anymore. Okay, so we got that one. Here's another one that I think is really important. If you don't understand either their plan or the strategy you're in or the products you own, and every time you ask, their explanation makes it worse, and your confusion grows, that's probably a good sign to go. It's safe to assume that if your advisor is licensed in whatever financial area they're licensed in, whether that is insurance only, or it's insurance and annuities, or it's stocks and bonds, whatever your advisor is pitching, they had to have passed at least an exam so that you've got some knowledge there. But having that technical knowledge and being able to translate it into normal English for people to understand who are not in our business is often, I've seen, a very difficult task for advisors. And I'm guilty of it too, even though I have a training in a background in acting and communication. It's sometimes easy to forget that you guys don't think on that same level in terms of terminology and have that same level of comfort with all of these financial terms and philosophies and strategies. So, for example, if I'm sitting here and you ask me, Jeremy, tell me again about why this strategy you have me in is the right one for me, and I start babbling on about Monte Carlo simulations and the beta on this is great, and look at this Sharpe ratio on this particular fund, and you walk out of my office more bewildered than you walked in, then it's not that your advisor may be a bad person, but they may be a bad communicator for you. And you may need to look for somebody who can explain things better. Okay. Early in my career, when I was doing so many new accounts, I would actually run my analogies by my teenage kids, and just say, guys, okay, I'm going to explain what a mutual fund is to you. And I would break out a notepad, and literally I'd draw like stick figures and dumping money into a bucket and all of these little diagrams. And if I got my teenage kids nodding, oh yeah, I get it, then I knew that was going to be something that really any client across the table was going to understand. So, like, for example, here, and I'm also watching as an advisor very carefully to see if the client is, or the prospective client is, if I'm losing them from across the table. You can tell because you guys get the glazy-eyed, deer-in-the-headlights look of what did he just say? And you don't want to say it because I know most people don't want to feel like they're not intelligent, or that they don't want to feel like they're not up to a snuff on this subject. Although it's impossible to be unless you've been trained in this business, because nobody gives you even a semester of personal finance at anywhere along the way. And I mean, our education in finance is terrible for America. I think it's because we can keep you in a consumer mindset if we don't really talk to you about the damage debt can do and what compound interest can do for your savings and things. So I think that the powers that be are better served if you are kept ignorant about money. So I think that's partly why they do it. But in the case of your personal advisor, if you're sitting there and you're asking a question about something, and here come the pie charts and the the Morningstar reports, and you're trying to figure out what they're talking about when they talk about fund overlap and all of those things. If you leave more confused than you came in, you need to have a new advisor. Okay, Albert Einstein said once that that if you can't explain something simply, you don't understand it well enough. So sometimes an advisor that's going on and on about a subject doesn't know it very well, or you can always usually tell too if somebody that it may be an honesty issue if they can't come right out with it. Like, for example, if you ask the advisor, how did I pay for this product? And if they give you some roundabout blah, 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 blah about contingent deferred sales charge, and we got this and we got administrative and blah, if you can't get a clear, concise, transparent explanation of how this cost you money to initially, and it's all over the place, you probably have either a person who doesn't understand the product well or doesn't want you to understand the product well. So find somebody that explains it in a way that you understand it and is patient with you. And like I do with my clients, I say, guys, at any point, stop me and say, whoa, back up and explain it again. I need to hear that the way I need to hear it. So, and that's their job to explain what they're doing. They are handling your money. You need to make sure that you know what's going on with it. Okay? So that's that one. Let's move on to the next. If your instincts tell you that something isn't right. Now that again should be a no-brainer, but I think the way that I used to hire employees when we were restaurant owners more than a decade ago, before I became a financial advisor, was I'd be sitting across the table from an employee, and I would ask them. At that point, my kids were only about 5 or 6 years old, and I said, and I just asked myself after all the interview questions were done, would I trust them to watch my kids for the weekend? And if they would do so, then I think I could trust them with my business, or at least with my customer, for the few hours a day that they were going to work. If I just felt like, God, I just would not trust them to watch my kids, I don't think I would trust them to watch my business, which was my livelihood. Okay? I think the same question is a good one to ask when you're sitting across or thinking about your financial advisor. Would I let them watch my kids or grandkids for a weekend? If you wouldn't, then why are you trusting them with your life savings? That makes no sense to me. So, but people do all the time. Well, my dad was like the guy, and so we're with him, but, I don't get a good feeling that I'm being treated fairly and honestly and that kind of thing. Guys, there's too many other financial advisors out there. There's too many, including robo-advisors now. There's too many other places that you can go for advice, for opinions, for account management, to be sitting there with somebody who you really don't trust, okay? And I put in the blog entry that I won't go into just to keep our time here short, that has to happen from the advisor looking at a prospective client as well, and we do that. When you first sit down with an advisor and you guys are assessing professionally whether you're going to be a good fit for the relationship, it's sort of like a first date, and you're looking across the table and you just, do we have enough in common to move forward? Is there an interest there? Is there a spark? And so there needs to be, for you and your advisor, a professional spark. And if it doesn't happen for you, move on to another advisor and find one. Ask family and friends. They'll always have an advisor that has done right by them and that they would recommend. And I hope, and I do get many, many referrals, but I always hope our clients are happy enough with the service and excited about working with me that they refer us. And that's really the mark of success as a financial advisor, or really any professional, is if you get the word of mouth of happy clients. That's terrific. But yeah, we've had to actually turn away clients at the table where I didn't get a good feeling about, for example, where this money came from. We're in a place right at the border of Mexico and Texas, where drug money is a problem. Money laundering is a concern we have to keep an eye on. And if you have people that have money and they just can't really explain how they came into it, or are evasive, kind of the question just doesn't sit right, we will pass on taking on their business. So something for you to do the same. Take a pass on people. You don't have to feel pressured or bullied into or intimidated into becoming anybody's client. It's your money. Okay, it's your money. You pick the person you want to have work it. How about just the last maybe 3 or 4 here? if you simply no longer enjoy the relationship. I hope that all of my clients see my name on the caller ID and call when I call and go, "Oh, Jeremy, awesome. Let me talk to him for a few minutes to see what's up." If it gets to the point where when you see that caller ID and you're like, "Oh, not him again," it's time to move on. Okay? This relationship is supposed to be a long-term, fairly deep relationship that develops between the advisor and the client, because you're going to share with me all sorts of very personal things. You're going to share with me all about your current, actual, real financial situation, not the one we pretend to our neighbors and family members, okay? The real one. How much debt do you really have? What really worries you at night? How's your health really? Okay, those kinds of things. What dreams do you have about the future? You're sharing with me your dreams and your aspirations about what you want the rest of your life to look like. And maybe you'd want to talk even about leaving behind money for family members or causes that are important to you. And then over the course of that time that you are a client, we have to do battle with things that happen in your life. We have to make course corrections because the markets did something unexpected, but we have to be there for each other. And my job is also a lot about helping you manage your emotions when things aren't going the way that we thought they would originally. So it becomes very deep and a very trusting relationship. And if you don't feel that anymore for that advisor, it's okay to go. There's nothing wrong with that. Okay? Last two, and we'll get down over here quickly. How about if you inherit money, for example? You don't have to automatically inherit the advisor that was managing the account. Your grandpa's advisor knew your grandpa, not you. And you should not be invested in the same mindset as your grandfather. A 30-year-old needs an advisor who understands millennials and Generation X and Y, not one who is dealing with the greatest generation. Okay? If your advisor is 65, they may have profound knowledge about the products they're comfortable with, but they will have probably very scant knowledge about some of the new things like robotechnology that might be of interest to you. Okay, I walk a real weird middle of the road where I'm 44 right now, so I have clients as young as early 20s and all the way into their mid to upper 80s, and we have I've got kind of the spread there. I'm like dead center where I'm still cool to the young people, but I'm old enough to know what I'm talking about to the older folks, so it works out well. But in your case, if you inherit it, for example, you inherit your parents' accounts. Your parents really, really love that advisor. It's okay to stay with them if you feel the same thing. If you feel like, yes, this person knows me, knows my family, understands that my parents or whoever this money was, that their strategy is going to have to be different from mine and is willing to bend and change to accommodate me as the client instead of just carrying on like this is still dad's money, then it's okay to stay. Otherwise, feel free to take that account and go. No issues with that. Okay, and finally, the last one, if you guys have any questions. If the advisor himself or herself steps down or retires, it's okay to leave also. And that's actually probably the easiest one for a lot of advisors or for clients to do. When I was an employee advisor at a major firm, your accounts, my clients' accounts were with that firm, okay? But your relationship was with me. And so when I decided at literally the earliest opportunity I could, I knew that I would have to be an independent advisor in order to do ethically what I wanted to do for clients, which was to work for you, not for a company who was so profit motivated. I needed to learn how to do things on the cheap, business-wise, so that I could do lower costs for you guys and manage your accounts in a more cost-sensitive manner. Anyway, so when I went independent, though, I had to go to all of my existing clients and tell them, guys, I know that your relationship's with me, and I know that you were used to seeing this particular firm's name on your statements, but I am leaving the firm. I'm forming my own firm, and I'd like consider coming with me. You do not have to, but if you liked the relationship, come with. And over 85% of the clients I had came with me, which is a really, really high number for the industry when advisors leave. But what a neat thing what a testament of the relationship when you have a client say, we're with you, Jeremy. We know that you've done right by us. We're with you. To me, that was the greatest, most honor feeling, and at the same time humbling one of the most humbling moments of my life, actually, when you had a person say, you know what, I trusted you with my money when you were with big firm, and you say you can do better for me by going independent. I'm going to trust you and take my money there. And I had so many of them do it. So when the advisor steps down and retires, it's probably a good time to either fire the advisor if you'd rather stay with the firm. Okay, you'll be assigned a new advisor, and then you have to figure out if you like that one. Or you can go with the advisor to their new firm. Okay. The one thing I would say to on this particular caveat, this particular reason, is please make sure before you make a change like that. And let me say this. This extends to all 9 reasons, or any other reason you may have to let an advisor go. Don't let a person like me trying to woo your business in do it without you carefully looking over what it will cost you from an account termination point of view, and also from a tax point of view. Not all the time will the investment that you're in be able to just lift up and transfer over to a new advisor. Sometimes it has to be liquidated and then reinvested over there. Okay, which if transfers are much, usually less costly than a liquidation and a repurchase. So just make sure that you have looked over the reasons to switch, and that you've also looked at the financial cost-benefit analysis to make sure that you still feel comfortable that it's worth doing. Okay? That's pretty much all I have today. I appreciate you guys' time very much. Trying very hard, even though the Money in 30 podcast is what it's called. I end up with a Money in 42, something like that. So I'm trying to thin these out as we go. But I'd love to hear from you about any feedback you have on our podcasts, or any other financial topics you'd like us to talk about. I'm more than happy to add that to our queue, and we'll add it in there, and we'll even say thank you on the air for it. My name is Jeremy Torgerson. I am the CEO again of nVest Advisors. Please check us out on the web at nvestadvisors.com. You can email me directly at jtorgerson@nvestadvisors.com. I hope you have a great week, and until we talk to you next time, take care.